All right, now let's bring in Courtney Garcia of Payne Capital Management, Shannon Saccocia of NB Private Wealth, Jordan Jackson of JPMorgan Asset Management. It's great to have everybody with us today. Jordan, I'll turn to you first. Apple, Broadcom, it does underscore what has been a resurgence of sorts for tech, especially on the larger cap side of things, right?
Absolutely, and you kind of hit the nail on the head. Will we limp to the finish line or will we walk? And the good thing about limping is you're still putting one foot in front of the other. And it does appear that at least to round out the end of the year, tech may very well be what drives us to further gains in the market through the end of the year. But I think we've just got to be impressed with the resilience of these companies' balance sheets. You keep in mind the Mag 7, they spend 60% of free cash flow on growth CapEx and research and development. So, as was highlighted, they're situating their balance sheets and their earnings growth potential for the economy of the future. And so we don't want to discount that. And so I think we'll continue to see this market concentration, but we still believe in that broadening out in earnings growth and broader participation as you look ahead towards 2025.
But you still think we'll see the concentration, though, into next year? I mean, people tried to write the story off a little bit, thinking that, well, these stocks are up so much, their valuations are stretched, their growth rates, while so super impressive, are slowing a bit. There's no way they could possibly maintain the growth rate that they had through this entire year. But here they are. They're saying not so fast, kind of back with a vengeance. Yeah,
I think some of it is the enthusiasm around incoming policy, right? The potential for deregulation that doesn't just benefit financials, which have also done very well as of late, but kind of this friendly, kind of business-friendly environment for mega cap tech potentially. So I think you've got some of this enthusiasm that's embedded in the rally, but the fundamental story, as you've highlighted, is still pretty constructive.
Court, Nasdaq's gone positive. It is the only of the three majors, anyway, that is positive on the week. Is this the place once again to lean into?
Yeah, I agree with the idea that this trade isn't going anywhere, but I also don't know if it's the best place to add all of your hard-earned cash that you have sitting on the sidelines right now, because realistically, this is a category, when you look at the Mag 7, who is facing slowing earnings growth and really high capital expenditures when it comes to artificial intelligence, and we don't know when that's going to be monetized. And I think this is one of those stories where we tend to overestimate what AI can do in the short term. We underestimate what it's going to do in the longer term. The question is, how much of that is going to be sustainable short term and what's priced in?
Isn't some of this already being monetized, though, for at least the hyperscalers? I mean, you can start to draw some lines, can't you, from spend to return?
Yeah, we're drawing lines, though, but I think actually seeing like the hard-earned cash on the bottom lines, I think that's the question. Apple is a good example of this, where everybody's saying, okay, they're going to get AI on their phones, they're integrating ChatGPT, but is it actually going to have this upgrade cycle that everybody expects it to have? We haven't seen that yet. So will it happen? It's possible. I don't know if it's going to happen as quickly as people are hoping it is. So I'm not getting out of this trade. I completely agree with you, Jordan. I think you have a lot of good points when it comes to this. So we stay in it. But if you haven't rebalanced your accounts, we have a lot of people who are 30, 40% above their targets in these categories. It's a good time to say, take some profits, spread out to other areas. Don't get out of it, but don't be overexposed.
Okay, Shan, how would you address that?
So I think we're talking a lot about AI, Scott, and I think if you look at mega cap tech and you think about this third wave of agentic AI and you think about the broadening, so I think that it goes beyond just the mega caps that we're talking about every day in terms of the AI impact. The other thing, Scott, as I would say, is we're really looking at the 3 C's. We're looking at the consumer, looking at China, and looking at cloud. And so if you think about Apple and Amazon, the opportunity there for consumer spending is starting to inflect again, even across lower and middle income consumer bases. We're starting to see that, we've seen a resilient consumer, but we're actually seeing evidence that the consumer is getting more constructive as we move into 2025. And that could certainly be helped by an expansion of real income growth. And you think about a potential, uptick in Chinese stimulus next year. And then you think about cloud consumption, which has really been on the sidelines. We're seeing evidence from an enterprise spend perspective that we could see some spending come back into cloud consumption. So all of that supports some mega cap tech names in general, but for reasons outside of the AI story that we spent a lot of time on this year.
Jordan, where are we overall on your view of 25 in the market? What kind of returns do you think we're going to get?
I think we're looking at high single-digit returns.
Singles?
High single digits.
Why
so let's call it between 5 to 10%. I think we're a little bit concerned about valuations, right? And I'm a little bit hesitant to make a big rate bet in terms of interest rates coming down. And so the question really becomes for next year, when will markets start to care about interest rates? And I think we'll see a 4.5% U.S. 10-year, potentially higher, depending on what kind of policy announcements that we get over the first half of 2025. And in that environment, I think you've got to get a little bit of valuation correction in the market. We can't keep trading at 22 times forward earnings. So assuming you get a bit of that valuation correction, maybe the big names kind of struggle a little bit, but you get some of the participation on the cheaper side of the market. I think that gets you somewhere in the high single digit.